Welcome to the deep dive. Today, we're really digging into the details, putting on our proverbial goggles for a deep dive into the due diligence reports for the Maple residences. This is one of Kuala Lumpur's big new launches, right in the W City OUG master plan. Our mission really is to sift through all this complex info and pull out what you, whether you're an investor or maybe looking for a home, actually need to know, a shortcut to getting fully up to speed.
Absolutely. And what's interesting here, I think, is that we're looking at it from two angles, aren't we? You got the investor focused purely on, the numbers, yield, appreciation, and then the potential homeowner thinking about lifestyle, maybe schools, even just, where to hang the washing. Their priorities can often clash. So our goal is a balanced view, the good stuff, but also critically the potential risks involved.
Okay, so the Maple residences, it's big, freehold, developed by WCT Holdings Berhad. We're talking 940 units, 3 towers, 32, 41, and even 51 stories high.
Yeah.
And it's a key piece of that huge 63-acre W City OUG master plan in Taman OUG.
And the big picture takeaway right from the start, our sources seem pretty clear on this. This project is really built for the long haul. It suits stakeholders with a long-term perspective. Definitely not a quick flip kind of property. You're essentially betting on the future value that master plan hopefully brings.
Right. Okay, let's unpack that, starting with the project itself, the anatomy. The marketing definitely positions it as upscale, family-focused, an iconic residential tower. And you do get a sense of that luxury just looking at the specifications.
You do. The standout feature, and it's a major selling point they're highlighting, is the floor-to-ceiling height. It's 3.6 meters. That's about 11.8 feet, which is, it's exceptionally high. Usually you only see that in really high-end, low-density luxury places. It just makes even smaller units feel much bigger, more voluminous.
And they seem to have focused on practical elements for families, too. All the layouts start with at least 3 bedrooms. Sizes go up to, 1,378 square feet for a dual key.
Yeah.
Solid timber floors in the bedrooms, which is nice. And they give you 2 or sometimes even 3 car park bays, addressing that parking headache up front.
Yeah, and it's interesting how they've tried to manage the feeling of density with 940 units overall. They've kept it to only 8 to 10 units per floor, which helps. And the lift ratio is decent, about 47 units sharing each lift. But the unique thing is this privacy zoning idea. They've basically broken up the long corridors into smaller zones, serving just 4 or 5 units each. It's an attempt to engineer a bit more exclusivity right outside your door.
Okay, but now we have to talk about the elephant in the room, design-wise. Digging into the reports, the most, let's say, polarizing decision seems to be no balconies.
At all.
In any unit type. Is that right? No balconies anywhere.
That's correct. And it's a really critical design trade-off they've made. The idea was by ditching the balcony, they could maximize the actual indoor usable floor space. And they try to compensate with these huge, almost floor-to-ceiling windows, creating what they call a glass house effect to bring in light and views.
But that's a massive compromise, surely, especially in the Malaysian market.
Oh, absolutely. It is. This could really put off a lot of traditional buyers here. People value balconies, for sitting out maybe a few plants, or just, frankly, the very practical need to dry laundry outside. You drive around KL on a weekend, you see laundry everywhere, right? It feels like a very, maybe North American design choice.
Yeah.
For this climate and this kind of high-density living, it definitely narrows its appeal for rentals and, importantly, for the subsale market later on.
Yeah, that no balcony point is huge. It really underlines that this isn't aiming for the typical condo dweller, perhaps. But speaking of design, the bigger picture here isn't just the building, is it? It's that whole master plan concept. Zoom out a bit. Location.
Location is key here. It's in Taman OUG, a mature, established area. That's a big part of the value proposition. But the project's ultimate success is really tied to delivering on that whole 63-acre W City OUG master plan. The vision is a self-sustaining city within a city, residential, commercial, green spaces, like an urban forest, a lifestyle village.
And the vision emphasizes walkability, shaded walkways. Sounds great on paper. But here's the catch, right? That master plan is being built in phases. So early residents, people moving into the Maple, they're going to be living slap bang in the middle of a construction site for quite a few years.
That's a reality. Waltz Residences was phase 1, the Maple is phase 2. There's still a lot more development planned for that 63 acres. It's a medium-term drawback for sure.
Okay, so what about connectivity right now? How easy is it to get in and out?
Well, for drivers, it's actually excellent. You're literally right next to the Kisses Highway, the Shah Alam Expressway. That gives you really quick access onto other major routes like M8X, MRR2. Getting around is pretty easy by car. Mid-Valley is maybe 8 or 9 kilometers away. Pavilion Bukit Jalil is super close, like 3 kilometers.
Okay, good for drivers. But if you rely on public transport...
That's where it's less ideal. Definitely less ideal. The nearest LRT stations, Awan Besar and Sri Petaling, they aren't really what you'd call comfortable walking distance. Awan Besar is about 1.2 kilometers away, maybe a bit far for a daily walk in this heat. So until that whole master plan with its walkways potentially improves things, it's very much a car-centric location.
And being right next to Kisses. That cuts both ways, doesn't it? Great connectivity kick. But what about the noise, the pollution?
That's the other side of the coin, exactly. It's a significant factor. The report suggests units directly facing the expressway will definitely have to deal with higher noise levels, period.
So that creates almost different classes of units within the same building.
Precisely. It creates clear tiers of desirability. Those inward-facing units overlooking the facilities or quieter areas, they're likely going to command a premium long-term.
Yeah.
Just based on simple livability and, how easy they'll be to rent out compared to the highway-facing ones.
Okay, that makes sense. Now let's shift gears a bit. This seems crucial. The developer risk. WCT Holdings Berhad.
Yes, this is critical. Because you're not just buying the condo unit, you're investing in the developer's ability, their financial strength, to actually deliver this entire 63-acre vision over many years.
In WCT, they're a big name, right? Diversified group construction, property development, investment. They've done major infrastructure projects,
right.
Airports, MRT lines. They have a track record.
They absolutely do have that track record, which makes the recent financial news, quite concerning. MRRC Ratings actually downgraded WCT's debt notes back in March 2024. They specifically mentioned worries about a declining construction order book, thin construction margins, and also a very high leverage ratio. Their borrowings went up to RM 3.1 billion in 2023.
Wow, 3.1 billion. High leverage. Does that often mean projects get delayed or maybe corners get cut if unexpected costs pop up?
It certainly introduces execution risk. That's the key takeaway. On top of that, they reported a pretty substantial pre-tax loss of RM 177.8 million in 2023. And maybe most worryingly for someone assessing risk, their Altman Z-score was very low. It came in at 0.86.
0.86. Now, for listeners, the Altman Z-score measures bankruptcy risk. Below 1.8 is considered high risk, so 0.86. That's basically flashing a big yellow, maybe even orange warning light, isn't it? What's the direct consequence for a buyer here?
The direct consequence is risk. Risk to the master plan's completion timeline and potentially risk to the quality of the final product. Now, they are making moves to try and stabilize things. They're planning to list their Paradigm REIT in 2025 to raise cash from their retail assets. But that underlying financial pressure, it's real, and it adds a definite layer of execution risk you can't ignore.
And talk about quality. You mentioned feedback from the earlier phase, Waltz residences.
Yes, that's right. The sources we looked at indicated that while Waltz was generally praised for its design, there was some anecdotal feedback, public reviews mentioning a bit of a gap between the luxury marketing and the actual workmanship on the ground. Now, for a premium press project like the Maple, where people are paying top ringgit, that raises a flag about quality control. It means buyers really need to be diligent during the handover inspection.
Okay, so financial pressure, potential workmanship questions. Let's bring it back to the numbers for the buyer or investor. Investment metrics. What does this luxury living actually cost?
Well, the launch pricing was definitely premium, averaging around RM 750 to maybe RM 800 per square foot. Now, if you compare that to the existing older condos in the OUG secondary market, they're often trading below RM 500 PSF.
Hold on. So you're paying potentially a 50% premium, maybe even more, compared to existing properties nearby. And that premium is based largely on the promise of a master plan that might take, 7 to 10 years to fully realize?
That's essentially the proposition, yes.
That feels like a big bet, especially considering the developer's financial situation we just discussed.
It is a premium for promise, absolutely. Now, looking at rental yield, on paper, it looks quite healthy. Initial estimates based on asking rents suggest a gross yield of maybe 4.5% to 5.5%. For instance, a typical 958 square foot unit, if bought around RM 800,000, might achieve an asking rent of RM 3,700 a month. That works out to about 5.55% gross.
That sounds good, 5.55%. But this seems like but that's based on asking rents, right?
Yep.
For a brand new place. What happens when suddenly 940 new units hit the rental market all at once when the project is completed? Won't that push actual rents down?
That's the major investor caution right there. You're absolutely right. That influx of nearly 1,000 units simultaneously could definitely suppress actual transacted rents, at least in the short term, maybe the first year or two, due to sheer competition among landlords.
Okay, so potential yield pressure. What about ongoing costs?
Yeah.
The facilities sound extensive, big pool, linear park. That usually means high maintenance fees.
And you'd be right. The cost of maintaining all those facilities, the 50-meter infinity pool, the 260-meter park, gym, gardens, it adds up. The maintenance fee is quoted at RM 0.39 per square foot, including the sinking fund.
Oof, 39 cents PS. That's quite high, isn't it?
It is on the higher side, yes.
So let's take a medium-sized unit, say 11,163 square feet. That works out to roughly RM 454 a month, just in maintenance.
Correct. Around RM 454 per month. That's a significant recurring cost.
Does that high fee pretty much wipe out a big chunk of that potential rental yield for an investor calculating their net return?
It certainly eats into it significantly. That 5.5% gross yield shrinks quite a bit once you factor in that RM 454 monthly fee, plus other costs like quit rent, assessment, any mortgage payments. It has to be part of the calculation.
Okay, so if you are an investor looking at this, given the premium price, the potential yield pressure, the high fees, and the developer risk, what's the smartest play? Is there a particular unit type that mitigates some risk?
Looking at the layouts, the Type D dual-key unit stands out. It's 1,378 institutional feet. It offers the most versatility. You could potentially rent out 2 separate spaces to different tenants, diversifying your income stream, or it's ideal for multi-generational families wanting separate living areas but under one roof. That flexibility adds value for future resale or rental appeal.
Right, that makes sense. Okay, let's try to pull all this together.
Let's consolidate, yeah. Clear takeaways for you, the listener.
Okay, first, for the potential homeowner, who is the Maple really suited for?
All right, for homeowners. This seems ideal for families who put a high value on security. They mention a 5-tier system. Families who really want those spacious indoor living areas thanks to that high ceiling and the minimum 3-bedroom layouts. But crucially, they have to be buyers who are fully okay with having no balcony at all. And they need to accept the medium-term reality of living near or in a construction zone with the associated noise and disruption as the rest of W City gets built.
And for the investor, it sounds like a pure bet on urban regeneration, basically.
That's exactly it. It's a strategic play, but it definitely carries higher risk than buying into an established project. Your potential appreciation is heavily tied to WCT successfully delivering those commercial parts. The lifestyle village, the shops, the offices, that's what's meant to justify the premium long term. So investors really need to be prepared for a minimum holding period of, say, 7 to 10 years. You need to wait for that master plan to mature.
So regardless of whether you're buying to live or invest, what's the most critical piece of advice right now?
Unit selection is absolutely paramount. You really must try to prioritize units facing inwards, away from the Kisses highway. That's crucial for long-term value and basic livability. And given the developer's financial pressures and that feedback from the previous phase, insist on a very thorough, meticulous physical inspection of the unit's workmanship before you accept the keys and make the final payment. Be picky.
Okay, last point. In a pretty crowded market, you've got lots of options nearby in places like Bukit Jalil. How does the Maple stand out? What justifies paying that premium we talked about?
Its differentiation really boils down to 3 main things, I think. 1, its role as part of that huge, integrated 63-acre master plan vision. That's the big promise. 2, its residential title. This is actually quite important because it means lower utility rates and property taxes compared to many competitors nearby, which are service departments built on commercial land. That affects your running costs. And 3, its deliberate focus on family-sized, flexible layouts, especially including that dual-key option, which is quite sought after.
Okay, that brings our deep dive on the Maple residences towards a close. It feels like we've seen a project with some genuinely high-spec, attractive features, a modern design sensibility, but it's also clearly grappling with the short-term pain of being part of a massive construction project and, perhaps more significantly, the financial question marks around the developer.
Yeah, it really feels like the whole project is making a big bet. It's betting that the future convenience and lifestyle offered by the completed master plan will eventually outweigh the current inconvenience of construction noise and traffic, and also outweigh the permanent compromise of that no-balcony design for many potential buyers. If WCT pulls off the entire W City vision successfully, then yes, the premium pricing could well be justified in hindsight. But if the developer falters or the master plan gets significantly delayed or scaled back, you could be left holding an expensive, high-density condo whose value is very dependent on promises that weren't fully kept.
So the final question we leave you, the listener, with is this. Does that promise of a future walkable city within a city justify paying that significant premium today for a lifestyle you might not fully enjoy for several years, especially when you factor in that financial warning signal from the developer's current Z-score, something to definitely mull over as you weigh your options in the KL property market?